Okay, this is going to be a TBS on accounts receivable. One of the things that dovetails into accounts receivable is the revenue recognition policy. So this is a copy of Nike's revenue recognition policy. And you can notice that they have three different types of customers: wholesale customers, digital commerce customers, and retail sales customers. Each one has different ways, different terms, different ways of shipment, different ways of recognizing revenues. So you can have many different types of customers in one accounts receivable file. So also take a look at sales reserve footnotes as well. Okay, so that's just a reminder. You might get an exhibit that just has the footnote information in it. So let's take a look at this accounts receivable roll forward. It's testing your analysis, your ability to analyze things. The instructions say to use this template to roll forward beginning accounts receivable balance, so you're doing the gross receivables. Input the answers. There'll be more details as to exactly how to input the answers in here. So this is a horizontal roll forward. When you have different subsidiary ledgers that all tie into the general ledger account, you have to do a roll forward for each one of them according to their transactions and the way that they handle their transactions. Okay, so let's take a look at our exhibits that we have real quickly. We're going to go over each one of them. I have a trial balance with my accounts receivable here. So I have my beginning accounts receivable balance. I have a memo from the accounting manager that summarizes how they recognize revenue. That Bamboo Imports uses the net method for B2B sales category, and B2C sales are recorded using the gross method. When I have a sales breakdown, I have the terms, and all sales for B2B are on credit. For B2C, 25% are in cash, 75% are on credit. So I need to separate out these total sales for identifying just the credit sales to put forward to the accounts receivable. I have to eliminate the cash ones. The governments are all credit accounts and they are net 60. Okay, so I have an exhibit for sales and I need to summarize the sales. Okay, so if I summarize the sales, I have totals here of 80 80,939, and here I have 44,599, and here I have 36,000. Okay, so I made a sum of those. So I noticed that my next exhibit summarizes the cash receipts received for the first quarter year two. My B2B, my cash direct for the B2C, oh, there it is, 11,149. So I subtract that from my total cash, and I have 33,450 on account. Okay, those are my receivables. So I have a note down here that says of the B2B cash collected, 6,000 was on accounts past the discount period. So I make a note of that. We have to deal with that. Then I've got some more accounting memos. The B2B sales returns are rare, accounted for using actual. The B2B sales have a return rate of 2.5% and are accounted using the estimated returns. The cost of goods sold is 60% of sales. A copy of the accounting policy for credit losses is identified here for the different methods. So we have an allowance account and we have a method for estimating that. So that we know about. So it's just not something that we have to do because we're doing gross receivables. You could call this a distractor, and we could ignore this and say that's a distractor. Okay. A memo from the accounting manager to the senior accountant for the first quarter. Looks like I've got a bad debt, and it looks like I've got a sales return identified and no NSF checks. And I also have in my exhibits an aged accounts receivable. So I look at my aged accounts receivable, and each one of these printouts could have a different aging depending upon the policy that you have with the customer. So I could have this different. So my totals are here, here, and here. So let's see what we have for our beginning work. Okay, so I'll put that off to the side. Let's take a look at our beginning balances here. 7513. Okay, 7513, 3,100, and 10,000. Okay, and the sum of those equals 20,613. I check that to my trial balance, 20,000. Okay, so that one agrees. I'm off to a good start. Now let's see what our, so I don't need the aging for anything else. I don't need the trial balance for anything else. Okay, so now let's go to our recording of sales. So my recording of sales, these are recorded at net. So these are net sales recorded at net of discount. So I have sales for the B2B of 80,939. I have sales here of 33,450. Okay, so we eliminated the cash sales from here, from the roll forward. And I have government accounts of 36 for sales. So I have my sales roll forward. Now, what are my decreases? My decreases are things like cash. So 78,107 minus the 6,000, okay, equals 72,107. So I have cash receipts of 72,107 that was made against those sales at net. They were paid at net. 6,000 of them were not. Okay, so my 6,000 is cash. My accounts receivable is at net of 5,880, and I have what's known as sales discounts forfeited, and it's 120. So these are my debits, and these are my credits of this journal entry. So we have to consider the accounts receivable only decreased 5,880. And this is added to the sales. Okay. Now I have cash receipts. Let me see. Cash receipts of 33,500 and 10,000 for government. I have a few adjusting entries to make. Let's see what my adjusting entries are. So it looks like I have my cash in here. All right. And my other adjusting entries that I have to deal with here are sales returns. And I have a bad debt expense and one actual sales return. Let's take a look at the journal entry method for sales returns. So my sales returns were 2.5% of 44,599. So for this quarter, the sales returns was 1,115. So here's my journal entries. First, to estimate it, sales return debited. It's a contra to the sales account. Refund liability, these are expected returns. And then we also have the 60% that goes to inventory returns expected, and cost of goods sold is then credited. The actual return, we debit the refund liability account, okay, because it came through, and we credit accounts receivable. and the inventory corresponding 60% also reduces the inventory returns expected, okay? And then the inventory is then debited when that item gets returned and they're able to put it back into inventory, if they are able to put it. It looked like it was a bamboo fountain or something like that. So I've got those two journal entries for the B2C that have to do with this, okay? Allowance for doubtful accounts, and this is B2C, B2C, okay? And this one was B2B. Good, okay. So I have a journal entry to write off. Okay, so the actual sales return did not affect accounts receivable. What did was when he actually returned it. So 560 when he returned it. Okay, and $700 for a bad debt. So the bad debt is written off. Anything else? NSFs were zero. Okay, let's take a look back at our accounts receivable aging. So here's my $700 write-off. That was in the 90-day column. They're bankrupt now, Robbins. Okay, I found Robbins. Park Slides was in the B2C. So Park Slides was 560. So obviously by the time they shipped it back and everything else like that, it was over 90 days, and we eliminated that. And then we made regular payments on that. So let's see what our balances are for the 331. Okay, so my beginning balance plus increases minus decreases, 10,465. 3,100 plus my sales minus my cash receipts minus the sales return and minus the write-off, 1,790. And government builds up to 36,000. Okay. So now I know what my total trial balance is going to be at the end of 331, and I know what my total numbers are. So once I run my trial balance, my final trial balance, I'll have to agree that to it. So what is my total there? My total is going to be 10,465 plus 1,790 plus 36. It's going to be 48,255. So that's quite a jump. So what do we see? Is there any analysis or memos that you need to talk to management about that involve internal control or something like that? Well, let's take a look. We went up on our aging here, and so something is happening here with increases and not enough decreases. So we do have a lot of people, more people this month that are not taking the discount. That could be a flag for economic pressures in the industry. Here, my accounts receivable went down. Well, we finally resolved some things and wrote some off. That's good. The government went up by 36,000. That's a pretty good size receivable from one or two entities that you might be doing something for. So right now you don't have any history, and on the aging, it said that government accounts are a new customer, and the custom-made signs, municipality names out of bamboo, and often have fountains, and they also do interior fountains for libraries and schools and things like that. So they have extensive budget authorizations required to make the purchase, and payments are usually a little bit of a slow process. A lot of times the entire accounts payable that are being sent out need to go to the board meeting for approval, and sometimes that's only held once a month. So some of these governments can run kind of slow, and they don't care, but they actually do pay. So there's no bad debt history, but should they be making a provision for bad debts in case something happens to a community? Yes, they should. So we might want to mention to them that they should establish a bad debt provision, a bad debt policy, or for write-offs of government accounts. It could happen. You could have a disaster hit a town where they are not able to make the payments that they had agreed to on their purchase orders, and for some reason want to or can't pay the amount. Okay, can happen. It's rare, but it can happen. So they should establish something. Let's go over our journal entries. So we talked about the sales returns. We also had the cash where we took out 6,000 out of our cash receipts. This would have been the journal entry for somebody that foregone their sales discount. So we would add that to sales because B2B was on the net method and they have not been grossed up in their sales. So we're adding the sales at that point when they forfeit the discount. The allowance for uncollectible account, if we remember, these are balance sheet accounts and we just slide that dollar amount over on the balance sheet and it doesn't affect the income statement. All right, that's all for this TBS here for accounts receivable roll forward. This is Professor Campbell. Thank you very much.